Hello again, fellow beach bum traders. Thank you for joining us for our video on Beware of Zombie Companies. So in this video, we'll explain what a zombie company is, what is the definition of a zombie company, how do zombie companies come about, and why should you beware of zombie companies. Also, we'll talk about why there's a recent increase in zombie companies, and again, what impact that may have on our economy, and also how rising interest rates, high inflation, and a recession can further exacerbate the risk of zombie companies, and again, why you should beware of zombie companies. So we'll get started, and again, we'll try to help you beware and avoid issues with zombie companies. So what are zombie companies? Well, let's look at the definition of a zombie company from Investopedia, and I will leave the direct link to this article in Investopedia in the description box below. So we can see Investopedia defines a zombie company as a company that earns just enough money to continue operating and servicing their debt, but are unable to pay off that debt. Such companies, given that they just scrape by, meeting overhead, wages, etc., have no excess capital to invest to spur growth. So again, they can't grow because all they're doing is servicing their debt. Zombie companies are typically subject to higher borrowing costs and may be just one event like market disruption, a poor quarter away from insolvency, bankruptcy, or a bailout. Zombies are especially dependent on banks for financing, which are fundamentally their life support. So zombie companies are company on life support, and they're also known as the living dead or zombie stocks. So some of the key takeaways from this Investopedia article is zombies are companies that earn just enough money to continue operating and servicing their debt. They have no excess capital to spur growth and are considered close to insolvency or bankruptcy. And in rare cases, a zombie company might stretch itself financially, produce a lucrative product, and reduce its liabilities. And therefore, zombies are high-risk investments and not for the faint-hearted, and therefore should be generally avoided. This graphic, this image is a simple explanation of what a zombie company is. So it explains zombie companies. It's a company that has high debts. They can only just service their debt. Therefore, they depend on low interest rates. So in a rising interest rate environment, their debt service becomes greater, and therefore their risk of insolvency or bankruptcy increases. So many rely on bailouts. Again, if something happens, they're going to go under, and someone would have to come and bail them out of their high debt, or again, they're going to become insolvent, go bankrupt, and die. They cannot reduce their principal of their debt. So again, a zombie company is one whose debt is so high, all they can do is pay the interest on the debt. They can't reduce the principal of the debt, and therefore they can't improve their situation. Too many of them undermined economic recovery. So again, they're unable to grow. They're consuming resources, consuming human resources, keeping people in jobs. They're a company that can't grow, can't really produce any additional GDP, and therefore it will stagnate economic recovery if too many of these companies are sucking up financing from banks, etc. So again, it's negative for the economy to have a lot of these zombie companies, and therefore it may be better for the economy if they just die off. So again, another reason why zombie companies are generally bad and to be avoided. Understanding zombie companies often fail, falling victim to high costs associated with debt or operations. So again, in addition to their debt service, if there are costs due to operations, particularly in a high inflationary environment, as those costs increase, it increases the risk that they're going to become insolvent and die. And again, they lack any resources for capital investment, so they can't grow. If a zombie company employs so many people that its failure would become a political or social issue, they might be deemed too big to fail. I'm sure you've heard that term, as was the case in the financial institutions during the 2008 financial crisis. So like Lehman Brothers, AIG, etc., were deemed too big to fail because it would disrupt the financial market, it unemploy a lot of people, etc. And there was a cascading domino effect. And so those zombie companies were bailed out. So given that, many analysts expect that zombies will eventually be unable to meet their financial obligations and therefore become insolvent, go bankrupt, lay off all their people, etc. And again, that has a cascading effect to all their suppliers, etc., the people they do business with. Such companies are considered riskier investments and will therefore see their share prices suppressed. So once someone identifies that a company is a zombie company, it's going to at least suppress, if not cause, their stock price to decline, because they can't grow, they're at higher risk, and as that risk increases, again, people are going to depress their stock price. So again, other reasons why zombie companies and their stocks are to be avoided. Zombies were first mentioned during the lost decade in Japan in the 90s due to a bursting asset price bubble. Companies dependent on banks. They were bloated, inefficient, failing. And again, economists argue that the economy would have been better served by allowing such poorly performing companies to fail. So again, the term zombie was picked up in 2008 in response to government bailouts in the TARP program. So again, these companies were bailed out even though they were zombie companies. They couldn't grow. All they could do is service their debt, etc. So generally, the number of zombie companies are small, but years of loose monetary policy with quantitative easing like we've had over the past couple of years, high leverage, historically low interest rates, again, things we've had the past couple of years have contributed to the growth of zombie companies. So nowadays we probably have a lot more zombie companies than we did in the past. Economists argue that such policies preserve inefficiencies, stifle productivity, growth, and innovation, and when the market shifts, as it is, zombies would be expected to be the first to fall victim, unable to meet their basic obligations as rising interest rates make their debt more expensive to service. And meanwhile, successful companies are less able to build on their success because of tight credit. So again, these zombie companies are not only risky, but they're siphoning off resources and depressing the growth of other companies that could be using those financial resources, human resources, etc., possibly more efficiency. While keeping zombies on life support may preserve jobs, economists note that using such resources is misguided because it impedes growth for successful firms and therefore inhibits job creation and also, again, innovation. So again, it's probably better that these zombie companies are allowed to die off rather than being propped up or bailed out. So again, you'll hear quite a bit of discussion about that. So investors in zombie companies, referred to as zombie investors, because the zombie's life expectancy tends to be highly unpredictable, zombie stocks are extremely risky and not suitable for all investors. A small biotech firm may stretch its funds extremely thin by concentrating its efforts in research and development in the hope of creating a blockbuster drug. But if the drug fails, the company can go bankrupt within days of the announcements. And we know that with biotechs, it tends to be a binary event on the results of their trials. They can go up 2x, 4x, 10x, but they can drop by 50% or just go bankrupt because now they don't have money to continue operations. So on the other hand, if the drug's successful, the company could profit and reduce its liabilities. In most cases, however, zombie stocks are unable to overcome the financial burdens of their high burn rates, and most eventually dissolve. So again, most biotechs are burning money. They may have debt service, so they may have to be just servicing their debt. And in a high increasing interest rate environment, their demise will be accelerated. So, given the lack of attention paid to this group, there are often interesting opportunities for investors of high risk tolerance and seeking speculative opportunities. So, that's what this article says. But again, in a recessionary, inflationary, increasing interest rate environments, this risk is exacerbated even further. So. Okay, Wikipedia also has a good definition, explanation of zombie companies, and I'll include the direct link to this Wikipedia article on zombie companies in the description box below. We can see they define a zombie company as in a political economy. A zombie company is a company that needs bailouts in order to operate, or an indebted company that is able to repay the interest on its debts but not repay the principal. So again, all they're doing is debt service. So zombie companies are indebted businesses that, although generating cash after covering running costs, fixed costs, etc., only have enough funds to service the interest on their loans, but not the debt principal itself. So as such, they're generally dependent on refinancing a maturing debt for their continued existence, and may face solvency risk should interest rates rise or investors withdraw from further financing. So again, in a rising interest rate environment as we are currently in 2022, this increases the risk of their insolvency as they have to refinance their debt or go to the capital markets to try to get money, which means further offerings, etc., and try to get the stockholders to give them further financing just to survive. So they explained the term zombie company was applied to Japanese firms supported by the Japanese banks in the lost decade in the 1990s due to an asset price bubble. And then they give an example, etc. I'll let you read that in more detail. Again, I'll leave the direct link in the description box below. So, and then in 2008, this term became more popular due to the bailouts from the TARP program. So again, the TARP program bailed out a lot of these companies that were deemed too big to fail, but were essentially zombies, and they would have gone under if the TARP program had not given them more money to pay their debt. By 2016, there was an economic downturn in China. So again, they talk about that, the issue of zombie enterprise. And zombie companies are those that remain in business but are so deeply in debt that they'll never catch up. So again, the expectation is they're never going to be able to get out of debt, so therefore they're just the walking dead, the living dead. In an age where U.S. monetary policy seems to ease by the day, enterprises of all sizes are tapping time and again into debt markets, potentially creating a corporate landscape littered with zombie firms. So again, in these environments where we had cheap money, free money, it increases the number of zombie companies, and we talked about the potential economic implications and harm that these zombie companies will continue to do if they continue to exist. So again, you can learn more about zombie companies in this article in Wikipedia as well. Here's another article I thought was good in terms of a definition and explanation of zombie companies as well from Market Business News. So I'll also leave the direct link to this article from Market Business News in the description box below. And you see they define a zombie company, also known as a zombie firm or the living dead, a term used for a firm unable to stand on its own feet. It either needs a series of bailouts or is kept afloat by lenient creditors and below market interest rates. It also refers to a firm unable to reduce what it owes but can repay the interest on its debt. However, if interest rates rise, as they are, it would probably cease functioning as a business. So shares of zombie companies are typically called zombie stocks. So again, dead money, or walking dead money. The term zombie banks refers to financial institutions that only exist thanks to government help. Here's the nice graphic that we already reviewed, so you can find that also in this article. Zombie companies attract resources that can otherwise be allocated to more productive enterprises. So again, they're sucking up resources that could probably be more productively used in other areas, other companies, other areas of the economy. They refer to Edward Kane, referred to American savings and loans that had effectively wiped out by commercial mortgage losses, but were allowed to continue to operate. So essentially they were bailed out. And unfortunately, things continued getting worse, and zombie company losses soon tripled. So again, this increases the overall risk. Institutions have distorted incentives just as the zombies do in the horror movies. So again, these zombie companies have distorted incentives just as zombies do in the horror movies. Media gave the term renewed popularity in the 2007-2008 global financial crisis when companies in North America and Europe received bailouts, and hundreds of thousands of others found themselves trapped in a seemingly bottomless pit of high debt. So again, zombie companies undermine economic recovery. Economists say too many zombie companies emerged after the global financial crisis in 2007, 2008, 2009, and their existence was holding back the economic recovery of many industrialized nations. You can see, the Bank of England says it was holding back their recovery. And again, you can read this in more detail, but the following features common in zombie companies, things to look for, things to be avoided. To avoid zombie companies, they're heavily indebted. They only generate enough income to pay the interest on their debt, but can't reduce the principal. They can meet loan interest payments depending on continuing low interest rates. So again, if interest rates rise, they may not be able to even pay the interest on their debt, and therefore their principal will increase, which increases their debt service, and eventually they will die, become insolvent, go bankrupt. They're unable to restructure and become more profitable because of the high cost in servicing their debts. The above the need for the company to go into receivership, so again, bankruptcy, preventing redeployment of capital and labor to move productive sectors. And again, once they go into bankruptcy, creditors can't get their debt repaid, etc. It pretty much ties up that money, those resources, until they either die or reemerge. So here's again some history of zombie companies that were holding back the UK environment in the early 2000s. Banks believe that zombie companies that are on their books still offer profitability to their bottom line. Again, they're servicing their debt, so they're paying interest to the banks. Venture capital incentives. So the question is, do venture capital incentives promote zombie companies? So again, the question is, do venture capital incentives promote zombie companies? So companies that manage to raise lots of money are not necessarily doing super well. Venture capital funds incentives drive them to fund companies that should have folded long ago. Many startups are overhyped, raise staggering amounts of money, and then stagnate. Money pits describes them as money pits that divert precious capital away from high growth enterprises that will eventually drive the majority of returns. So these zombies also hurt investor returns, reduce the value of employee stock options, and mislead the public about the health of the privately held businesses. So again, we've kind of seen this play out, right? So many companies got staggering amounts of money, and they're not making any money, and will probably reduce the value. And some have misled the public about the health of their business going forward. So again, zombie companies are bad from a venture capital standpoint as well. Finally, from this article, they have about a 5-minute video at the bottom of this article that explains zombie companies, etc. And I won't play that here in consideration of your time. But you can go to the bottom of this Market Business News article and also listen to that video. So I hope that helps. Lastly, I wanted to review this very recent article from Fortune magazine that was republished in Yahoo Finance as of October of 2022, titled "A Huge Number of Zombie Companies Are Drowning in Debt." And it has a CEO sees a reckoning as interest rates soar. So again, in this rising interest rate environment, it's beware of zombie companies. So they start out, zombies are real, at least zombie companies are real. So again, zombie companies are real. So loosely defined as economically unviable firms that need to borrow to stay alive in an era of cheap money and high risk investing fueled the rise of the Walking Dead in the business world over the past decade. So the CEO references David Traynor from this investment firm New Constructs, believes that there are now roughly 300 publicly traded zombie companies. And with interest rates soaring, money isn't as cheap as it used to be, which means zombie companies are facing a reckoning, which will affect both investors and the economy as a whole as recession fears mount. So when economic reality hits these companies and they do go to zero or close to it, which we're going to see in spades, a lot of investors are going to get crushed. Trader told Fortune, we're going to see a potentially huge impact on consumer demand. There's going to be a lot of people that are ticked off. So again, as these companies fail, those holding the bag, the stocks, are going to be hurt. And again, this is why we're saying beware of zombie companies. So what exactly is a zombie company? Some debate, but they describe 13% of U.S. listed companies could be considered zombies, so it's a pretty high estimate. Firms that haven't produced enough profit to service their debts. Last year, the Federal Reserve found that roughly 10% of public firms were zombie companies in 2019, using slightly more rigorous criteria. And then Deutsche Bank found in April of 2021 that over 25% of U.S. companies were zombies in 2020. So in 2000, only about 6% of U.S. firms were in the same situation. So again, huge increase in the number of zombie companies. So it's something to beware of and avoid. Prescient predictions about zombie companies in the recent years also believes that the numbers of those failing firms in the U.S. has risen dramatically over the past few decades. Defines zombie companies as less than 2 years of lifeline. So again, if their cash burn if their cash pile will only allow them 2 years or less of cash burn, and such as a biotech, etc., then they're considered a zombie company and at high risk of insolvency. They also struggle to differentiate themselves, have poor margins, lack options for future profitable growth. So there's a very low likelihood that the cash burn is ever going to get better. So again, they have a list of about 300 publicly traded zombies that they track. So some examples they use are Carvana, Peloton, AMC, GameStop. So again, all very high-risk zombie companies. So these companies didn't respond when asked for comment about being named as a zombie company in this article. Many of these zombie companies will eventually see their stock prices drop to zero as the market recognizes they can't survive rising interest rates. So again, all of these companies, named and unnamed in this list, the expectation is eventually they'll go to zero, go bankrupt, and go away. Federal Reserve has raised interest rates 5 times this year to kill inflation, and we're expected to get more interest rate hikes very soon. The soaring borrowing costs for corporations, That affects zombie companies who are struggling to pay their debt service already. While potential downfall of zombie companies could be painful for investors and the economy in the short term, Trainer made the case that it won't be the worst thing in the long run. Again, we talked about how they suck up resources in the economy. He argued it represents a necessary cleansing of the financial service system. So, how did zombie invasion happen in the first place? So, how did this zombie invasion happen in the first place? So, in the years following the global financial crisis of 2008, central banks around the world, in an effort to reignite economic growth and reduce unemployment, decided to slash interest rates, institute other loose monetary policies, what they call quantitative easing, and to spur lending and investment. So it was the beginning of the era of free money that put cash in the hands of speculators, and they turned around and bought risky financial assets, sending them to new highs. So then they give an example back from 2008, 2009 that you can read about the increase there. And then the speculative era hit its peak in 2021 after stimulus checks fueled a boom in retail investing, and Bitcoin soared, IPO markets soared, meme stock traders pushing zombie companies like AMC and GameStop even higher. So Trainer believes the era of speculative investing increased the number of zombie companies in the U.S., dramatically hurting productivity and made the economy more vulnerable during recessions. And we're in a recession now, so their vulnerability is even higher. I think long-term zombies have caused a meaningful reduction in growth and prosperity. Effectively, what a zombie stock is a waste of capital. So it's dead money. To the extent that the capital is wastefully employed in these businesses, they have actually never produced any real economic value, and they're losing the opportunity to invest in more productive areas. So again, dead money. Deutsche Bank said zombie companies weaken economies by minimizing the growth of firms and industries in which they operate. The survival of zombie firms is like a drag on productivity growth as these firms congest markets and divert credit investment skills from flowing to more productive and successful firms. Trainer says survival of zombie companies is a threat to the U.S. in an increasing competitive global economy. So again, continuing to prop up, bail out these zombie companies, allow them to exist is a negative for the economy. If we don't have efficient and productive capital markets, we lose probably one of the biggest competitive advantages that we have as a country, which is our ability to allocate capital most efficiently and rapidly to its highest and best use. That's part of the problem. People forget that this is what capital markets are about. It's about reallocating capital to its highest and best use. So the fall of zombies and lessons for investors. So the era of zombie companies may be coming to an end as interest rates rise, forcing unprofitable firms to burn more and more cash. The downfall of zombie companies will ultimately be beneficial for the economy and help teach younger investors who have lived through an era of speculative excess about the importance of risk management. So that's, opinionated way to say it's going to hurt people who have invested in these zombie companies, stay invested in these zombie companies. When they eventually fail, essentially you're going to lose your money, or worst case, that's the worst case, or at least it's going to be dead money and they get bailed out and it remains dead money. So I'll let you read in more detail some of his other comments, specifically about the meme stocks, AMC, etc. He's making the case that, again, meme stock mania, etc., the difference between speculating and investing. And again, he goes on and describes speculation between investing and speculating and investing, and argues that we're seeing the impact of ignoring Graham's warnings, where Graham's warning So hopefully in this video we helped you understand what a zombie company is, how to spot them, why you should beware of zombie companies, how the risk of a zombie company and getting stuck, getting trapped by a zombie company, that risk is exacerbated by rising interest rates, high inflation, and going into a recession. So let us know what do you think of all of this information? What do you think of this discussion on zombie companies? Let us know in the comments below, in our Discord, in our Facebook group, via social media. Again, you can find the links to all of these discussion forums in the description box below, also on our homepage, beachbumtrading.com, bum without the U. And again, let us know what you think of all of this about zombie companies. How can you spot them? How can you avoid them? Beware of zombie companies, etc. Let us know what you think, and how can we help you beware of zombie companies and avoid getting trapped in a zombie company. So again, let us know your thoughts. Let us know what you think of this video, and we hope this all helps, and good luck and have a great trading day. The content of this video was produced by BeachBum Trading. We hope you will choose to also join us in the BeachBum Trading community and subscribe to our YouTube channel. Visit us at our homepage at beachbumtrading.com, the bum without the U. Similarly on Twitter, BeachBum Trading, bum without the U. On Facebook and in our BeachBum Trading Facebook group. Please follow us on Pinterest and on Instagram. All of the links to our social media sites will be included in the description box below, and we hope you will choose to subscribe to our BeachBum Trading YouTube channel and follow us on social media. Thank you. We also cordially want to invite you to our new BeachBum Trading Community Discord server, where we can have discussions on all topics related to trading, success in trading, investing, etc. You can see alerts when we make trades, changes to our watch lists, etc. So again, please join us in the new BeachBum Trading Community Discord server. You should be able to find a link in the description box below. You can also find a link in the social media category on our webpage, beachbumtrading.com, without the bum without the U, and also in the link section on the About page of our YouTube channel, etc. So again, we look forward to seeing you in the BeachBum Trading Community Discord server soon. Wave and say hello. BeachBum Trading also now has a site on Patreon. If you are willing and able to help support our efforts to produce all the content and help you achieve the financial freedom you want, deserve, to be able to live the beach bum lifestyle or any other kind of lifestyle you would like, and you're willing and able to help support our efforts in these regards, we hope you'll choose to visit our Patreon page. You can get access to our new BeachBum Trading Community Discord server, which is currently under construction, but you will get access to the Discord server by supporting us through Patreon. Again, this is all currently under construction, but you can see we just have the default levels, membership levels, but again, each level allows support, allows access to our Discord. We're also posting our trade positions initially in our Discord, and again, we greatly appreciate any support that you're willing and able to provide. So thank you for your consideration. Another way that you can help support BeachBum Trading and being able to produce frequent quality content for you for free on YouTube, etc., is in addition to subscribing to our BeachBum Trading channel, hitting the like button on our videos, and hitting the notify so you're alerted when we release further videos. You can also choose to show your support for BeachBum Trading with a super thanks, which you can find below this video. If you hit the heart with the $sign, the super thanks, again, you can financially support BeachBum Trading in whatever amount that you wish, and we greatly appreciate your support, and that will help us, again, be able to produce frequent quality content that we can provide for you and all your fellow BeachBum traders around the world for free on YouTube. So again, we greatly appreciate all of your support, and thank you very much. Thank you again for watching our video. We hope that you liked it. If so, please smash the like button, give us a thumbs up. If you're not already subscribed, please consider subscribing to our BeachBum Trading YouTube channel. Please share this video with your fellow traders and friends. And please give us your feedback and any recommendations for improvement in the comments section below. And let us know what else we can do to help you in your trading career. Thank you again, good luck, and have a great trading day. If you like this video, we hope you will choose to subscribe to our YouTube channel by clicking on the box in the upper left-hand corner. You can watch another video like this by clicking on the box in the lower right-hand corner. And we have a whole playlist of videos like this that you can access via the box in the upper right-hand corner. Our latest video is available in the box in the lower left-hand corner. We hope you like this and have a great day.